We're at the end of the year, so the natural place to start is looking into 2020. What should we expect from the M&A market going into next year?
So for 2020, I'd say there's a couple of important trends we should watch out for. One, the cash-rich acquirers, the strategics, are going to continue to be active. A lot of the targets that we're going to see are getting larger and larger. Companies are staying private longer. And I think we're going to see more and more power in these negotiations being exercised on the part of the targets. And also in the space for the financial sponsors, this whole private equity space, I think there's a lot of dry powder there, so much in the hands of the groups that we traditionally put in limited partner category. And I think we're going to see more deals where these so-called limited partner types start dominating the deals, and we won't necessarily see the name brand PE funds leading.
I'll come back to PE in just a moment, but just sticking with the strategics for now.
Yeah.
Obviously, the biggest issue if you're in the board is you need confidence about the outlook. You need to know, to some extent, where the market is going, where the economy is going. How does anyone execute a large transaction going into what is already a volatile backdrop and then putting the election on top of that?
Yeah, it's a great tension that we have, right? Because we have investors who are pushing and pushing on companies to do accretive M&A. On the other hand, then you go into the boardroom, they want to do these deals, but there's projections, internal forecasts that are all over the place because of the unpredictability of tariffs, the election year, all the different macro factors that are floating out there. So the advice in boards is don't get ahead of yourself. Figure out what internal projections you have, which ones are pie in the sky, which ones were put together by some consultant who didn't even really understand the business necessarily, and take your time, have that in order, because you don't want to look like you're backing your internal forecasts into the deal that you end up with.
But to your point, a lot of investors are very, very keen to see M&A and particularly anything accretive, but also anything that just sort of increases scale. What's the opportunity cost of doing nothing for these companies?
Oh, it's potentially huge. I mean, because you're just sitting there, letting money sit there, low interest rates, and then,
your rivals are getting bigger all the time.
So you're being compared to your peers. There's always the activists looming. Everybody's everybody wants to have very high votes. The independent directors are more sensitive than ever about showing up nicely on the votes and getting good recommendations, and a lot of that's tied to share performance.
Right, all of which leads back to your point that if you are a private company, perhaps going public is less attractive. So talk to me about some of those options. If you're a tech company, privately owned, you're selling to a big public tech company, how can you negotiate a deal that is slightly better for you and doesn't necessarily expose you to the rigors of being a public company?
Right, so when you say the public company rigors, everybody's very intimidated. So you have all this movement toward dual class, insulate me. So what can you do then when you're selling to one of the big private buyers or big public company buyers of the private companies? But what we're seeing here is I think the founders are exercising more and more power, and they're going to start getting very interesting deals. It's a two-way street. So the buyers are going to say, well, maybe we won't give you all your consideration on day one, and they'll have ways of making sure they stick around. On the other hand, we're going to see more and more autonomy, I believe, for these founders when they get bought into big buyers, which almost leads you to a sort of a new era of conglomerates.
Sort of tech conglomerates going in the same way that the industrials did a century ago.
Yeah, and that's the only way to attract these, because remember, founders, they're very, very proud of their companies, and they want to keep their mission, and I think we're going to start seeing a way to do that even though you're selling your company. So you're not just in and out. You keep your autonomy. We may even see some real creative structures, maybe some independence on the board structure, even though they're 100% owned subs.
And the other headwind for big tech, and obviously something that would play a significant role if we were going to see more M&A, is potentially the breakup of some of the big techs or some pressure on them to break up and have less market power. Does that really cramp their ability to go out and find deals?
Well, everybody's thinking about regulatory issues. It's very, and it's interesting with the election year. The big question is, well, is it better to do now, better to wait? Who knows what's going to happen? I think ultimately, if you can get your forecasts in order and justify the deal, you know that doing nothing with your cash is not going to justify sitting around, that folks are still going forward.